Hey everyone, this is May from the What Changes. Thank you so much for joining me on this urgent update because the silver market is moving incredibly fast right now, and I know many of you are watching every tick, wanting to understand exactly what these moves mean for your stack, your savings, and your daily life. That is why we break it all down here on What Changes, turning big macro events into real wallet impact for normal families like yours. And today we have a massive story. Silver has just rebounded sharply to $84, but behind the scenes, the COMEX registered inventory has crashed even further to only 87.68 million ounces, while March standing for delivery sits at 51.8 million ounces. This overnight inventory drop is making the default risk skyrocket higher than we have seen in months. The paper price may have bounced, but the physical squeeze is accelerating hard in the next 15 minutes. I am going to walk you through every single number, the reasons why this rebound is actually super bullish for physical owners, the decoupling with Shanghai, the geopolitics driving it all, the historic timeline, and most importantly, the exact steps you should be taking right now to protect yourself. So if you are new here, welcome, grab a coffee or a notepad, because we are going deep on this March COMEX delivery crisis that is unfolding live on March 4th, 2026. And by the end, you will know exactly how this changes everything for your financial future. Guys, this is not normal market action. Silver just rebounded hard to $84 after yesterday's dip. But the real story that almost nobody is talking about is happening inside the COMEX vaults, where registered silver, the only metal that can actually be delivered against futures contracts, has crashed overnight to just 87.68 million ounces. I am pulling the Fedloot latest data straight from the CME Group warehouse report that dropped in the last few hours, and the March standing for delivery is still holding extremely heavy at 51.8 million ounces. That means buyers are demanding over 59% of the entire deliverable supply right now, and we have already seen more than 74 million ounces pulled out in the last 60 days. This kind of drain is insane, and it is exactly why the default risk is skyrocketing, even as the paper price bounces back to $84. Let me explain what all these terms actually. For those who are newer to the channel, the COMEX in New York is where most of the world's silver futures are traded, and when someone stands for delivery, they are saying they want the real physical silver, not just a cash settlement. The registered category is the critical one, because that is the only silver the exchange can legally deliver against those contracts. Eligible silver is in the vaults, too, but it belongs to private owners and cannot be touched for futures. So when I tell you, registered is down to 87.68 million ounces, while 51.8 million ounces are already claimed, that is an incredibly tight situation. The rebound to $84 might look like relief on the surface, but it is actually the banks trying to shake out weak hands before the real physical crunch hits. And that is what makes this moment so dangerous and so exciting at the same time. Let us look at the cold, hard facts from the latest warehouse report. Registered silver, the only metal available for immediate delivery, now stands at just 87.68 million ounces, after another 1.1 million ounce drop overnight. March standing for delivery is 51.8 million ounces across 10,360 contracts. That is still over 59% of the entire registered inventory already spoken for. We have delivered 74 million ounces in the last 60 days alone. That is roughly 85% of the current registered stock, gone in 2 months total. COMEX inventory continues to fall, and eligible silver sits around 268 to 271 million ounces. But again, most of that cannot be used for delivery. The math here is simple and brutal. If even half of the standing contracts actually demand physical metal, the vaults simply do not have enough. And that is why default risk or forced cash settlement at a massive premium is now a very real possibility in the coming days and weeks. The rebound to $84 today is being driven by short covering and safe haven buying, but it does nothing to refill those emptying vaults. In fact, the higher the price goes, the more pressure builds because more buyers want to take delivery. This is the classic setup for a squeeze, where the paper price tries to run, but the physical reality cannot keep up. Here is what the mainstream financial media will not tell you. While COMEX paper silver has rebounded to $84, the Shanghai Gold Exchange is still trading the equivalent of around $103 to $105. That is an $18 to $19 premium over the West, and that gap has actually widened again overnight. The two markets have completely decoupled. China is aggressively hoarding every ounce of physical silver they can get their hands on for solar panels, electric vehicles, electronics, and strategic reserves, while Western banks continue to use futures contracts to try and suppress the price in New York. This decoupling is not some small anomaly, it is a structural shift that has been building for over a year, and every time we have seen it in history, it has preceded massive rallies in physical metals. The rebound to $84 might feel good on your screen, but for anyone holding actual bars and coins, it is confirmation that demand for the real thing is stronger than ever, and the paper game is losing control fast. Now let us talk about the geopolitics that is pouring fuel on this fire. The ongoing tensions in the Middle East with Iran, the Strait of Hormuz, disruptions and fresh reports of tanker convoys being stopped are driving a new wave of safe haven buying into gold, and silver oil prices are spiking again, which flows straight through to higher costs at the gas pump and in every grocery store. When global uncertainty rises, investors and central banks turn to silver as both a monetary metal and an industrial powerhouse. This increased demand is exactly why the COMEX registered inventory keeps crashing, even as the paper price rebounds to $84. On top of that, the industrial side of silver is absolutely on fire right now. Solar energy, electric vehicles, 5G infrastructure, and electronic manufacturing are all consuming record amounts of silver, and with China locking up supply, the Western world is feeling the pinch. This combination of monetary safe haven demand and exploding industrial need is what makes the current COMEX situation so explosive. The rebound we are seeing today to $84 is not the end of the story. It is the beginning of the next leg higher, once the delivery pressure really kicks in. Realistic timeline based on the latest data in the next 7 to 10 days, we are going to see even more delivery notices hit the COMEX, with only 87.68 million ounces registers and 51.8 million ounces already standing. Expect forced settlements, emergency trading halts, or even a cash settlement at a huge premium in the next 30 days. Silver is very likely to gap back above $100 and push toward $110 to $120 minimum, as shorts are forced to cover gold, will follow to fresh all-time highs. Historic precedent backs this up strongly. Every single time we have seen this level of registered drain, combined with a wide Shanghai premium, physical silver has rallied between 25 and 50%. Within weeks, the rebound to $84. Today is actually the classic shakeout phase. It scares retail sellers into dumping, while the smart money and industrial buyers keep accumulating quietly before the real explosion higher. This is the moment many analysts have been warning about for months, and the data is now confirming it in real time. If you already own physical silver, hold every single ounce. This is exactly why you stacked in the first place. Do not get shaken out by any short-term paper volatility. The rebound to $84 proves the underlying strength. If you are still in the process of building your stack, now is the time to focus on 1-ounce rounds and 10-ounce bars before dealer premiums start climbing. Again, for beginners, start small, buy from reputable dealers, and avoid overpaying on premiums today, because as the squeeze builds, those premiums at local coin shops are going to rise quickly. For those of you with retirement accounts or 401ks, look into whether you can allocate a portion to physical metals through approved self-directed channels. And for families watching this, remember that every spike in oil and every disruption in supply chains eventually shows up in your grocery bill, your gas tank, and your rent. Silver has historically protected purchasing power during exactly these kinds of crises. We have talked many times on this channel about how the dollar has already lost so much value over the decades, and events like this COMEX crisis only speed that process up. So think long term. Do not panic on red days or get overly excited on green days. Instead, focus on ownership of the real physical metal, not paper promises that may not be deliverable. When the crunch finally hits, store your silver safely, whether at home in a private vault or through a trusted custodian. The key is having the actual metal in your control when the system is stressed. Thank you so much for watching this deep dive all the way to the end. If it helped you understand what is really happening, please smash that like button, subscribe to the channel, and turn on notifications because we are tracking this story every single day. The changes are coming fast, and you need to stay ahead of them. This is May from the What Changes channel, signing off. Stay safe, keep stacking smart, and I will see you in the next video.